The system is breaking. Not in the dramatic way people expect, with alarms and headlines screaming collapse, but in the quiet, methodical way that empires have always declined, through debt, through promises that cannot be kept, through the slow erosion of trust in the very foundation of what we call money. And if you're paying attention, if you understand the cycles that have repeated across centuries, you know that we're not approaching the edge. We're already standing on it. Right now, at this exact moment, the global financial system is carrying more debt than at any point in recorded history. Not just government debt, not just corporate obligations, but a web of interconnected liabilities so vast, so complex, that most people don't even realize they're trapped inside it. And here's what matters. When debt reaches these levels, when the cost of servicing those obligations begins to exceed what growth can support, the rules change, the playbook shifts, and the assets that thrived in the old system suddenly become vulnerabilities, while others, the ones most people have ignored, become lifelines.
If this type of clarity helps you see what's coming before the crowd realizes it, subscribe now. Because understanding the global debt cycle and what it means for gold isn't just about protecting wealth.
It's about positioning yourself on the right side of a transformation that will redefine money itself. Don't wait for the shift to become obvious. By then, the best positions will already be taken. Let's be direct about something. This content is educational and not financial advice. Its purpose is to help you think more clearly about the forces shaping markets and your decisions. What you do with that clarity is entirely your responsibility. Now, here's what you need to understand. Debt isn't evil. It's a tool. Used wisely, it accelerates growth, funds innovation, and builds prosperity. But like any tool, it can be misused. And when societies, governments, and central banks lean on debt, not as a bridge to future productivity, but as a permanent solution to present problems, the tool becomes a weapon. It turns inward. It consumes the very system it was meant to support. We've been in an expansion phase for decades. Since the end of the gold standard in the early 1970s, since the fall of the Soviet Union, since the rise of globalization and the digital economy, the world has been on a borrowing spree. Debt has grown faster than income, faster than GDP, faster than any reasonable measure of productive capacity. And for a long time, that worked. Interest rates kept falling. Central banks kept intervening. Asset prices kept rising. Everyone assumed the game could continue indefinitely. But cycles don't work that way. They never have. What goes up doesn't stay up forever. And what's been borrowed must eventually be reconciled, either through repayment, which becomes impossible when debt outgrows income, through default, which destroys confidence and triggers contagion, or through inflation, which erodes the real value of the debt by destroying the purchasing power of the currency used to repay it. History shows us that when debt reaches the levels we're seeing today, inflation becomes the path of least resistance. It's politically easier than default. It's more controllable than collapse. And it allows governments and central banks to manage the transition without admitting failure. But inflation has consequences, real consequences. It punishes savers. It rewards debtors. It transfers wealth from those holding paper assets to those holding real ones. And it fundamentally alters the relationship between currency and value. That's the inflection point we're approaching. The moment when paper promises begin to lose credibility and the world remembers why gold has been trusted for thousands of years, think about the mechanics for a moment. Gold doesn't pay interest. It doesn't generate cash flow. It doesn't offer dividends. And for that reason, during periods of low inflation and stable currencies, it often underperforms. Why hold something that just sits there when you could hold bonds that pay yield or stocks that grow earnings. That logic makes sense in a stable system, but we're not in a stable system anymore. We're in a late-stage debt cycle where the very currencies those bonds and stocks are denominated in are being debased to manage obligations that cannot otherwise be met. When inflation rises, when real yields turn negative, when the return on cash and bonds falls below the rate at which prices are increasing, gold stops being a non-productive asset. It becomes the most productive asset because it's the only one maintaining purchasing power. It's the only one not being diluted by monetary expansion. It's the only one that doesn't depend on a government's promise or a central bank's credibility. And here's the part most people miss. This isn't about gold going up. It's about currencies going down. Gold doesn't change. An ounce of gold today is chemically identical to an ounce of gold 1,000 years ago. What changes is the amount of currency it takes to buy that ounce. And when debt forces central banks to choose between defaulting on obligations or printing money to cover them, the choice is always the same. They print, they expand the money supply, they inject liquidity, and in doing so, they devalue every unit of currency in circulation. That's the core mechanism of the global debt cycle. Expansion, over-leverage, crisis, and then monetary response. And every time that cycle repeats, gold reasserts itself as the ultimate store of value. Not because it's perfect, but because it's independent. It exists outside the system of promises and liabilities. It can't be conjured into existence by policymakers. It can't be devalued by decree. And that's why in moments of monetary stress, it becomes indispensable. Look at the data. Every major debt crisis in modern history has been accompanied by a surge in gold prices. Not immediately, not in the early stages when everyone still believes the authorities have it under control. But in the moment of recognition, when the market realizes that the only way out is through currency debasement, when investors understand that holding paper is a losing bet, that's when gold moves. And it doesn't move incrementally, it moves violently, because the shift from complacency to awareness happens fast. And when it does, the demand for real assets overwhelms the supply. We're seeing the early signs of that shift right now. Central banks, the very institutions that issue fiat currency, have been net buyers of gold for over a decade. Not small amounts, record amounts. China, Russia, India, Turkey, Poland, even countries that were historically dollar-centric are diversifying into gold. Why? Because they see what's coming. They understand that the dollar's role as the world's reserve currency is under pressure. They recognize that holding too many dollar-denominated assets exposes them to U.S. policy decisions, to inflation, to the risk that the currency loses value faster than the assets gain yield. This is a profound signal. When the players closest to the monetary system, the ones with the most information and the most at stake, are buying gold, it's not speculation, it's preparation. They're positioning for a world where currency stability can no longer be assumed, where debt burdens force uncomfortable choices, where the old rules no longer apply. And it's not just central banks. Institutional investors, family offices, hedge funds, the sophisticated money is rotating into real assets. They're reducing exposure to long-duration bonds. They're questioning equity valuations built on cheap credit. They're looking for hedges against a scenario that feels increasingly likely, a scenario where inflation remains elevated, where growth disappoints, where currencies weaken, and where the gap between what governments promise and what they can deliver becomes impossible to ignore. The global debt cycle doesn't move in straight lines. It moves in phases. We've been in the expansion phase for so long that most people have forgotten what the contraction phase looks like. But those who study history, those who understand cycles, know that we're entering that phase now. The debt is too large, the growth too weak, the imbalance is too severe. Something has to give. And when it does, gold won't just be a nice diversifier. It will be the asset that determines who preserves purchasing power and who doesn't. It will be the difference between those who prepared and those who hoped the system would somehow fix itself. Consider the math. If global debt continues to grow faster than GDP, which it has been for years, the debt to GDP ratios will reach levels where traditional solutions stop working. You can't grow your way out of it because growth is constrained by the very debt you're trying to service. You can't cut your way out of it because austerity collapses demand and triggers recessions. You can't tax your way out of it because there aren't enough productive assets to tax without destroying the incentive to produce. That leaves one option: inflate, reduce the real burden of debt by making the currency worth less. It's not honest, it's not fair, but it's the path that allows the system to continue functioning without catastrophic disruption. And that path, that choice, is what makes gold essential. Because if you're holding assets denominated in a currency that's being deliberately weakened, you're not preserving wealth. You're watching it erode in real time. This is why the global debt cycle matters so much for gold. It's not about short-term trades or momentum plays. It's about understanding the fundamental relationship between debt, money, and value. When debt reaches unsustainable levels, the monetary response is predictable. And that response, whether it comes through rate cuts, quantitative easing, yield curve control, or direct fiscal stimulus, all leads to the same place: more money chasing the same amount of real resources, which means higher prices, which means inflation, which means currency debasement. And in that environment, gold doesn't just hold its value, it captures the value that's leaking out of paper assets. It becomes the reservoir where purchasing power flows when confidence in fiat systems weakens. That's not theory, that's historical pattern. And we're watching that pattern set up again right now. The next phase of this cycle will surprise most people, not because the signs weren't there, but because they weren't looking at the right indicators. They were watching stock prices and GDP growth and employment numbers and all lagging indicators, all measures of what already happened. But the leading indicators, the ones that tell you what's coming, are in the debt markets, in the bond yields, in the spreads, in the currency fluctuations, and increasingly in the price of gold itself. Gold is sending a signal. It's been quietly grinding higher even as central banks raise rates, even as the dollar strengthened temporarily, even as inflation appeared to moderate. That tells you something. It tells you that the market is looking beyond the short-term noise in pricing and the long-term reality. The reality that debt levels are untenable, that monetary policy is trapped, that the only way forward is through debasement. And here's what makes this moment different from past cycles: the scale. We've never had global debt at these levels. We've never had central banks with balance sheets this bloated. We've never had negative real yields across so many major economies for so long. We've never had this much dependence on continuous monetary intervention just to keep the system stable. All of that means the eventual adjustment will be larger, more disruptive, and more consequential than anything we've seen in recent memory. That's not fear-mongering. That's pattern recognition. Every debt supercycle in history has ended the same way, with a monetary reset. Sometimes gradual, sometimes sudden, but always transformative. And in every one of those resets, gold has emerged as the anchor, the asset that maintained value when everything else was being revalued downward. So what does the global debt cycle mean for gold? It means gold is not optional. It's structural. It's not a speculation. It's insurance against the most likely outcome of an over-leveraged system It's the hedge against central banks doing exactly what they've always done when faced with impossible choices: print, inflate, and hope the transition doesn't trigger panic. The opportunity here is profound, but it requires seeing beyond the surface. It requires understanding that markets don't collapse in straight lines. They pivot, they adjust. And in those adjustments, wealth doesn't disappear. It transfers from those holding the wrong assets to those holding the right ones, from those who trusted the system to those who understood its limitations. Gold represents that understanding. It represents the recognition that debt has consequences, that currency is a claim, not a certainty, that real assets outlast paper promises, and that in a world where governments and central banks have painted themselves into a corner, the path forward will favor those who position themselves outside the corner entirely. This is the moment, not years from now, not when the crisis is obvious. Now, while gold is still accessible, while premiums are reasonable, while the majority still dismisses it as a relic, because once the recognition phase begins, once the market collectively understands what the debt cycle means, the move will be swift, and by then, the cost of entry will have multiplied. The global debt cycle is not a distant abstraction. It's the force shaping every market, every currency, every policy decision being made right now. And gold, far from being a passive observer, is the active beneficiary of a system that has no choice but to debase its way forward. That's the reality. That's the cycle. And that's why gold matters more today than it has in decades. Now, let's go deeper into the architecture of this cycle, because understanding the surface is not enough. You need to see the layers beneath, the mechanisms that drive the cycle forward, the pressure points that determine when it breaks, and the specific dynamics that make gold not just a hedge, but a necessity in what's coming. Debt cycles follow a predictable sequence. It starts with productivity, real economic growth. New technologies emerge, industries expand, workers become more efficient, output increases faster than inputs. In this phase, borrowing makes sense. You borrow to build a factory, and that factory produces more than the cost of the loan. You borrow to fund education, and that education increases earning power. The debt is productive. It generates returns that exceed its cost. This is the virtuous phase. But then something shifts. The easy gains are captured. The low-hanging fruit is picked. Growth begins to slow, but the appetite for borrowing doesn't. Now, debt is used not to fund productive investment, but to maintain consumption, to fund government programs that can't be paid for with taxes, to support asset prices that have risen beyond fundamental value, to cover obligations that were promised when growth was higher. The debt stops being productive and becomes extractive. It pulls forward consumption from the future without creating the means to pay it back. This is where we are now. Across the developed world, debt has been growing faster than GDP for decades. The ratio of total debt to economic output has climbed to levels that historically have always led to crisis. And the composition of that debt has shifted. Less productive investment, more consumption, more entitlements, more financial engineering. The system is running on borrowed time in the most literal sense. Here's the problem. When debt reaches these levels, the economy becomes hypersensitive to interest rates. Even a small increase in borrowing costs can trigger widespread distress. Businesses that were barely profitable at low rates become insolvent. Governments that could manage their debt service at 2% rates face exploding deficits at 5%. Households that stretch to buy homes or cars find themselves underwater. The entire structure becomes fragile. Central banks understand this. That's why Despite talking tough about inflation, despite raising rates temporarily, they always end up reversing course. They have to, because the alternative is systemic collapse, default waves, bank failures, recession turning into depression, and politically, that's unacceptable. So they choose the other path. They lower rates again. They restart asset purchases. They inject liquidity. They do whatever it takes to keep the system functioning, even if it means sacrificing the value of the currency. This is the trap, the debt trap. Once you're in it, there's no clean way out. You can't grow fast enough to outrun the debt because the debt itself constrains growth. You can't default because that would destroy the financial system. So you inflate, you devalue, you transfer the burden from debtors to creditors, from borrowers to savers, from those with liabilities to those holding currency. It's a hidden tax, a stealth confiscation, and it's already happening. Look at what's happened to real yields over the past 15 years. Real yields are the return you get on safe assets after adjusting for inflation. For most of the period since the financial crisis, real yields have been negative or near zero. That means if you held cash or treasury bonds, you were losing purchasing power. Your nominal balance might have stayed the same or even increased slightly. But what that money could buy was declining. That's the inflation tax at work. And it's about to accelerate. Because here's what most people don't realize. The debt levels we're carrying now require financial repression to be manageable. Financial repression is when governments deliberately keep interest rates below the rate of inflation, when they force savers to accept returns that don't keep pace with rising prices. It's a way of inflating away debt without calling it default. And it only works if you can trap capital. If people can't easily escape into alternatives, that's why central banks coordinate, why capital controls get discussed, why there's increasing pressure to regulate or restrict alternatives to the traditional financial system. But gold is different. Gold can't be repressed. It doesn't have a yield that can be manipulated. It doesn't have a promise attached to it. It exists outside the system. And that's precisely why it becomes so valuable in a debt cycle like this one. Because as financial repression intensifies, as real yields stay negative, as currencies lose purchasing power, people look for exits. And gold is the most liquid, most universally accepted, most historically proven exit available. The relationship between debt cycles and gold prices is not linear. It's not smooth. There are long periods where nothing seems to happen, where gold trades sideways while debt accumulates in the background. These are the periods when confidence remains high, when people still trust that central banks can manage the situation, when the narrative holds that growth will return, inflation will stay tame, and everything will work out. During these periods, gold looks boring. It looks like a relic, and many investors abandon it. But then the narrative breaks. Something happens. A policy mistake, a geopolitical shock, an unexpected inflation surge, a bank failure, a currency crisis. The triggers vary, but the result is the same. Confidence cracks. The realization spreads that the debt can't be managed without consequences. And suddenly gold is no longer boring. It's the only asset making sense, the only one that's not tied to a promise that's being broken. These inflection points are impossible to time precisely, but they're inevitable. The math guarantees it. When debt service costs rise to consume all available resources, when growth can't keep up, when the only option left is monetary expansion, the inflection point arrives. And when it does, gold doesn't move in percentages, it moves in multiples. Consider the 1970s. At the start of that decade, gold was fixed at $35 an ounce. By the end, it had peaked above 800. That's not a 20% gain. That's more than 20 times. And it happened because the debt and inflation dynamics of that era forced a repricing. The dollar was being debased, trust in the monetary system was eroding, and gold captured the value that was leaking out of paper assets. Or look at the 2000s. Gold started that decade around $250. By 2011, it had reached 1900. Again, not a modest move, a transformation. And again, it happened because the debt accumulated during the preceding decades came due. The financial crisis revealed the fragility, and the monetary response, massive quantitative easing, negative real rates, confirmed that debasement was the chosen path. We're setting up for the next repricing now. The debt is larger. The imbalance is more severe. The tools available to policymakers more limited. The dependency on low rates and monetary stimulus more entrenched. And the recognition, still nascent but growing, that this cycle will end the same way the others did, with currency debasement, with inflation, with a flight to real assets. Gold is already beginning to reflect this. Even as nominal rates rose temporarily, gold held its ground. Even as the dollar strengthened on a relative basis against other weakening currencies, gold remained resilient. That tells you the market is pricing in the end game. Not the next quarter, not the next year, but the inevitable conclusion of a debt cycle that has no other exit. And here's the crucial point. You don't need to wait for the crisis to position. In fact, waiting is the mistake most people make. They wait for confirmation. They wait until gold has already doubled or tripled. They wait until the narrative is shifted and everyone agrees. By then, the easy gains are gone. The prices are higher. The availability is constrained. The smart money positioned early. The crowd arrives late. Positioning now, while the consensus still dismisses gold, while the majority still believes central banks have everything under control, while debt is still seen as manageable, that's where the asymmetry lies. The downside is limited. Gold is a real asset with thousands of years of history. It's not going to zero. But the upside, if the debt cycle plays out as every other debt cycle has, is enormous. Think about the forces converging. Government debt approaching or exceeding GDP in most developed nations. Central bank balance sheets expanded to unprecedented size. Unfunded liabilities and pensions and entitlements reaching into the hundreds of trillions globally. Geopolitical fragmentation, reducing cooperation and increasing the risk of currency conflicts. De-dollarization efforts accelerating as countries seek alternatives to US dollar dominance, and inflation proving far stickier than the transitory narrative suggested. Each of these forces alone would be significant. Together, they create a perfect storm for currency debasement. And in that storm, gold is not just a safe haven. It's the asset that captures the revaluation, the asset that benefits directly from the monetary response, the asset that becomes more valuable precisely because the currency it's priced in becomes less valuable. This is not speculation. This is not hopeful thinking. This is structural analysis, understanding systems, incentives, and constraints. Understanding that when policymakers face a choice between political survival and currency stability, they choose survival every time. And that choice, repeated across countries and across time, creates the conditions for gold to shine. There's another dimension to consider: the velocity of change. Past debt cycles unfolded over decades. Communication was slower, capital flows were more restricted, adjustments happened gradually, but today information moves instantly. Capital can shift across borders in seconds. Sentiment can reverse overnight. That means when the inflection point comes, When the recognition spreads that the debt cycle is ending and debasement is the path, the repricing of gold could happen far faster than in previous cycles. We've already seen glimpses of this: flash crashes in bond markets, sudden currency dislocations, rapid shifts in commodity prices. The system is more volatile, more interconnected, and more prone to nonlinear moves. Gold, being relatively small in market size compared to bonds or equities, can move dramatically when large flows arrive. And those flows, when they come, will not be retail investors buying a few coins. There'll be institutional allocations, sovereign wealth funds, central banks, and high net worth individuals moving billions. That's the setup. A debt cycle nearing its terminal phase, a monetary system trapped between impossible choices, a recognition slowly building that the only way forward is through debasement, and gold sitting at the center of it all as the logical, historical, and structural beneficiary. But let's address the objections, because there are always objections. Some will say that technology has changed everything, that digital currencies or blockchain will replace gold, that we're in a new paradigm where old rules don't apply. These arguments sound sophisticated, but they miss the point. Technology changes the medium. It doesn't change human nature. It doesn't change the fact that debt must be reconciled. It doesn't change the incentives of governments facing insolvency, and it doesn't change the need for an asset that exists outside the system of liabilities. Digital currencies, particularly central bank digital currencies, are not alternatives to gold. They're extensions of the fiat system. They give authorities even more control, more ability to monitor, to restrict, to manipulate. In a world moving towards CBDCs, where every transaction can be tracked and controlled, the case for gold becomes stronger, not weaker, because gold is the ultimate privacy asset, the ultimate opt-out, the ultimate insurance against a system that has grown too powerful and too prone to abuse. Others will argue that gold doesn't keep up with inflation in real time, that there are periods where it lags. That's true, but it misses the larger point. Gold is not a day-to-day inflation hedge. It's a catastrophic risk hedge. It's protection against the moment when inflation spirals out of control, when currency crises hit, when the system breaks. In those moments, gold doesn't just keep up. It surges. It overcompensates for the periods of underperformance. That's the nature of tail risk insurance. It doesn't pay off every year, but when it pays off massively. Some will point to the opportunity cost, that gold doesn't yield anything, that you could be earning returns elsewhere. Again, this is true in stable times, but we're not in stable times. We're in the late stage of a debt supercycle. The returns available on paper assets are increasingly illusory. Nominal gains that don't account for currency debasement, yields that don't keep pace with real inflation, stock valuations built on borrowed money and buybacks rather than genuine growth. The opportunity cost argument assumes the alternatives are safe. They're not. And then there's the argument that governments could confiscate gold again, as they did in 1933. This is possible, but it misses several points. First, the political and logistical challenges of confiscation today are far greater than they were 90 years ago. Second, even in 1933, the confiscation was a recognition of gold's value. The government wanted it precisely because it was the real asset backing the monetary system. Third, there are ways to hold gold that reduce confiscation risk, allocated storage in jurisdictions with strong property rights, physical possession in secure locations, diversification across forms and locations. The risk exists, but it's manageable, and it's far less than the risk of holding only paper assets in a debt crisis. The bottom line is this: every objection to gold is an objection that applies far more forcefully to the alternatives. Fiat currency is being debased. Bonds are offering negative real yields. Stocks are priced for perfection in a world that's far from perfect. Real estate is illiquid and often leveraged. Cryptocurrencies are volatile and unproven as long-term stores of value. Gold, for all its supposed limitations, has survived every monetary system, every empire, every crisis for thousands of years. That track record is not an accident. It's a reflection of fundamental properties: scarcity, durability, fungibility, recognizability, portability. These properties don't change. And they don't stop mattering just because we've entered a digital age. So where does that leave us? It leaves us at a juncture, a moment where the smart money is positioning for what history and logic tell us is coming: a repricing of currency versus real assets, a recognition that debt levels are unsustainable and that the resolution will come through debasement, and a shift in portfolio construction from trusting the system to protecting against it. Gold is not the only answer. Diversification matters. Real assets, productive businesses, hard commodities, even select equities and sectors that benefit from inflation all have roles to play. But gold is the cornerstone, the foundation, the asset that performs when trust erodes and systems strain. It's the one asset that doesn't depend on someone else's solvency, the one asset that central banks themselves still hoard, the one asset that has never gone to zero despite countless currencies and empires doing exactly that. The global debt cycle is not some abstract academic concept. It's the dominant force shaping our economic reality. It's why interest rates can't be normalized without triggering crisis. It's why inflation won't stay contained despite official reassurances. It's why central banks will ultimately choose debasement over default. And it's why gold, far from being a barbarous relic, is the most relevant asset for the times ahead. This is not about predicting the exact date or the exact trigger. It's about understanding probabilities, about recognizing that when debt reaches these levels, the range of possible outcomes narrows dramatically, and most of those outcomes favor gold. Either inflation accelerates and gold captures the debasement, or deflation forces more monetary stimulus, which eventually leads to inflation, and gold captures that too. Or currency crises erupt and gold becomes the safe haven, or geopolitical tensions rise and gold benefits from uncertainty. The scenarios differ, but the conclusion is the same. You don't need to be certain, you need to be prepared. And preparation means allocating to assets that protect you when the consensus is wrong, when the system doesn't self-correct, when the authorities run out of tools, when the debt finally matters. That moment is coming, not in some distant future, but in the years immediately ahead. The debt cycle is maturing, the imbalances are peaking, the recognition is spreading, and gold is ready. It's been ready for 5,000 years. The question is whether you'll be ready too, whether you'll position now while there's still time, while prices are reasonable, while availability is adequate, or whether you'll wait for the crowd to validate what should already be obvious. The choice is yours. But understand this: the global debt cycle doesn't care about your choice. It will unfold according to its own logic, its own timeline, its own brutal mathematics. And when it does, those who prepared will preserve their wealth. Those who didn't will watch it vanish into the same place all paper wealth goes when the promises behind it can no longer be kept into thin air. Gold won't vanish. It never has, and it never will. That's not faith. That's physics. That's chemistry. That's history. And that's why it matters now more than ever.